Hello, everyone. Welcome to session number 2 of Business Analysis series. And today we'll build upon the first session that we took. That was around what are qualities of a great business. And we also understood few exceptions around that. So for people who have not seen our session number 1 of Business Analysis, I would request you to watch that first. It would be much more helpful then if you come back and watch session 2. But if you have not watched it, then also it's okay. But it's just a suggestion. So let's start with today's session. So the topic of today's session would be good businesses versus good investments. Now, I think since 2017, we have seen this debate go above the roof, be it the American markets or be it the domestic market. We are actually seeing investing society getting divided into two aspects. That is, that good businesses, as defined by, we have learned in session number 1, high ROCEs and good growth rates, turns out to be good investment. All right, that means you should buy every company which has got high ROCEs of 25-30% and buy them and hold it for a very long period of time, for 7 to 10 years, right? And the rate at which you buy them, that is the starting valuations, won't matter that much. And there is then second class of society that says that basically starts with the quote of Benjamin Graham, that it's the valuation which helps you make return, not just a business, right? Starting valuations are very important if you want to make good returns. Now, what is our thought process and what we teach in our academy to our students is very simple, that it's unnecessary debate. All thing that matters is in the coming 2-3 years, what kind of profit your company can clock. And even if we take the historical median multiple of that company, if you are able to exit around that multiple, will you make a decent CAGR or not? And by decent, we mean anything above 18 to 20%. That's it. Forget about the debate of value, growth, tech stocks, manufacturing stock, ECG stock, non-ECG stock, infra stocks, FMCG stocks. It's immaterial. So what we have done is today in this session, we've actually brought that debate to reality. We have just seen emotions coming out here and just few snapshots of exceptions. So when someone comes and says that good quality businesses outperform in long run, so someone will come and post a technical chart of HUL. कि देखो ना HUL ने भी 10 साल कहाँ return दिया था, so this is wrong. When someone says, starting valuations matter a lot, so that, another guy will come and post a lot of 3-5 P stock example, which have given practically no return for a very period of time, for a very long period of time. We find both of them very wrong approaches, because even if you want to prove that aliens exist or not, we can find one exception and prove that. It's not about exceptions, right? It is about broad general principle which has a high base rate or higher odds कि ज्यादातर टाइम ये चीज करेक्ट होगी. एक्सेप्शंस तो आपको दुनिया में हर जगह ही मिलेंगे. So we brought few statistics and few numbers into this debate. Okay, are good businesses only good investment? We would like to frame this question in a different manner. Are only good businesses only good investment, or is every good investment a good business? I think you should know the answer. The answer is no, obviously not. But we would also, support that ideology. Okay, why a lot of time it's better just to buy good businesses, irrespective of valuations. We'll discuss pros and cons of both. So first of all, let's pick up from where we left in session number 1. We understood that 10-year sales CAGR of greater than 10% and average return on capital employed of anything above 12.5% is called a good business. We have just done one thing here. We have taken this assumptions. We have gone to Screener. We have our own premium account. We went and we inserted this criteria under the screen. So actually see how many companies come under this filter. So we did 3 criteria. We inserted 3 criteria there. sales CAGR of 10% in the last decade, average ROCE of 15%, a bit above 12.5, and we have filtered only companies with market cap of 500 and above, just to avoid that debate of lower small caps में बहुत volatility होती है, penny stocks भी आ जाएंगे वहाँ पे, accounting you cannot trust. So just to avoid that debate, we have kept a filter of market cap of greater than 500 crore. So they are about 197 companies only out of approximately 4789 listed companies on BSE that meets the above three criteria. That's why you will understand why some people call that India's investable universe is very shallow, right? Because there are only 197 companies out of 4789 where the long-term criteria are getting met. There are a lot of cyclical businesses which perform good for 1 to 2.5 period kind of time frame. You enter and exit. That's perfectly all right. People have midterm frame business which have been very consistent. The number is low. I don't have data for developed markets, but for India, this is the number. So below here is the screenshot of those 197 companies. You can download it from our forum. We have also uploaded it on the forum. So if you want, you can download it. And this data is as per 23rd Feb 2022. So if you today, the number we will ROCE of 15% only as a benchmark. A lot of people who are firm believer in value investing, etc., Buffett approaches, they would become dissatisfied. Okay, what is just 2.5% alpha over cost of capital of 12.5 and more innovation. We tweaked our time the set of criteria were sales CAGR of 10%, but average ROCE of past decade of 20%, and market cap again greater than 500 crore. So from 197 companies, we came to 123 companies because ROCE we increased from 15 to 20. So as per screener, right, there are approximately only 120. Now, obviously, you won't find banks here, right? Because banks majorly work on ROE. And we have kept ROCE as filter. ROCE of banks is very poor in the range of 7 to 8%, which is absolutely a wrong metric also, because the debt by equity ratios are very high there. So ROE should be tracked, but we are keeping ROCE for simplicity. Now, one of the most fascinating insight that comes out of this 123 companies here is the returns are clustered. Generally, if you would have read, Chalni Munger or Michael Mombusin a bit, you will see them using this thing, this term that, profit pools basically. Okay, every country has profit pools, few industries which are abnormally highly profitable. So what we did, we took this 123 companies, we actually went individually to BSE just to, reconfirm the industry of screener. And we filtered out, what companies belong to which industry. And that was fascinating. Approximately were just chemical companies. Approximately 11% companies were pharma companies, 10% capital goods, 5% each will go to FMCG, auto, ancillary, and building material, like Serra Centriware or Astel Polytechnic, piping companies, Centriware companies, etc. If we pick up the top 7 industries, 1, 2, 3, 4, 5, 6, 7, approximately 18, 20, 33, 1043, 1053, and approximately again 1063, 68. Approximately 65% of companies out of those 123 companies just come from the 6 industries. You can actually term chemical sector because there are agrochemical, specialty chemical, etc. Right? different types of chemical there, but 65% companies broadly from this 6 sectors. Now, this is the hunting zone. Okay, if you're a fresher, you want to understand a business, you want to understand a business as it is, you don't know anything else. You need to pick up one or two industry and start reading more about them. This is a hunting zone. You can pick up those industries out, any industry out of the 7, because this have an inherent nature of being highly profitable. Okay, that was one of the most important thing here. But one more thing is what I would like to highlight, and that is a very contrarian approach. Not exactly contrarian, but just a sort of observation that intentionally we have kept few names here. Life insurance, footwear. So it would be like, why have you kept this name in that list? Okay, because out of 123 companies, only 2 companies, that is just 1.6% of the quality basket. Let's call this 123 companies at the quality basket. Only 1.6% of 123 companies, that is 2 companies, belong to life insurance. So this is not a good industry, because the proportion in quality basket is very low. That's the immediate conclusion a lot of people arrive at. But my point is, it is not only important to see what number of companies of an individual's industry comes in the overall quality basket. We also need to see how many total companies are listed of that industry. So if you go and see life insurance, in particular, I have the snapshot again from screener only. Let's go here and see this, right? There are broadly 3 companies listed in life insurance space in India: HDFC Life, SBI Life, and ICICI Pru. Out of that, you have 2 companies in the quality filter. That means 67% of the listed universe is quality of life insurance. So even though overall the number looks very small in terms of quality basket representation, but actually it is a very high quality industry in terms of ROCs and sales growth. So just don't look at this data from one angle, look at it from multiple angles. Point number 1. Second, sometimes even the outliers are equally important. So when you see footwear, there's only just one company from footwear industry in this 123 companies. So again, your point should be, why, you are showing this data of one company. Let's only talk about, concentrated industries. And if someone would have followed the market, again, you will have this data point. यार इंश्योरेंस में तो ऐसा भी नहीं है, मतलब फुटवेयर में तो इंश्योरेंस जैसा भी नहीं है, खाली 3 कंपनीज है. फुटवेयर के अंदर तो 10-11 कंपनी लिस्टेड है. In fact, that is a better point. I will tell you why. So if you look at footwear, we went into footwear and leather products, mainly footwear. So if you look forward, there are a lot of footwear companies listed, But these are the few companies. By sure, I know they are footwear companies. So when an industry is a bit big, but still only one player is able to, generate that kind of profit, it becomes even more important. Why? Because any good investor who would like to, take a position in this industry, this will be his first pick, right? Which will provide this company, impetus of valuation support. And this company must be doing something very fantastically different and good, because of which they are able to outperform the entire industry averages in terms of sales growth or ROCE. So even that can be one more angle through which you can look at this data. There can be multiple angles. My only point to portray this 2 specific example was so that you have a bit broader mindset. Okay. Now we have simply first of all understood that we now have 123 companies as quality basket. But first, let's understand, does quality equal to return? So it was very important to understand out of these 123 companies that come into quality basket, how many have actually provided good returns also of 20% plus CAGR. Let's call that good return. That's genuinely good over long term, 20% plus CAGR. So we actually went ahead and we did a bit additional filtering. So this time we inserted 4 criteria. Obviously, 3 criteria same: sales growth of greater than 10%, past 10 years, average ROCE of greater than 20% of past decade, market capitalization greater than 500 crore, but this time one more criteria, that is 10 years stock CAGR of greater than 20%. मतलब stock return भी होना चाहिए ऊपर के साथ. And the number of companies that came as per this criteria with 79 companies, the snapshot for which is here below. So out of 123 companies which were called quality companies, like, right, 79 companies also provided great returns. So if I divide 79 by 123, that's a strike rate of 64%. That means approximately 65% of the quality companies actually turned out to be great investments too. I know we could have inserted much, better criteria like float of stock or free cash flow growth rate of 15-20%. We can do that. We can do a lot of interest. The point is, we never wanted to get into a situation of analysis paralysis. We just wanted to state one point that yes, quality companies generally have good strike rate of turning out to be quality investments too over a long time frame. It's practically proved by even such simple data points. Then why complex it, right? Now let's go forward. All right, but we want to understand कि ठीक है 20% तो बहुत ही अच्छा रिटर्न है. क्या cost of capital तो beat होता है क्या? It would be fantastic if majority of the companies are able to at least generate a stock CAGR of 12.5% and above. So we tweaked the criteria again. This time we inserted this thing into screener. Sales CAGR of greater than 10%, average ROCE of greater than 20%, market cap of greater than 500 crore, and stock CAGR of 12.5% and above, right? Which is our cost of capital as per session 1. We have learned, right? A business should generate more than 12.5% return on capital to be termed as a good business. Now, as per this filter, 93 companies, if I'm not wrong, I will go and check the data. I'm sure broadly. Yeah. Out of this filter, approximately 93 companies ended up generating a 12.5% CAGR. That is a strike rate of 75%. So if I summarize, the quality basket comprised of 123 companies. Out of that 93 companies, that is 75% of the 75% companies gave a return greater than cost of capital. And approximately 79 companies, that is a strike rate of 65%, actually gave a return higher than 20%. So if I draw a timeline, these are returns 0%, 12.5%, 20%, and anything above 20. So total companies with return greater than 12.5% were 93. And out of that, 73% companies actually, in fact, gave 20% more CAGR, right? So I think you understand the sales pitch now. Okay, if I come and I want to convince you that quality companies provide great returns, I think these statistics are sufficient to impress you. And if you end up quoting Mr. Buffett here, that a strike rate of 50% is great in the world of investing. Kenneth Andrade sir actually came for a guest talk also at our academy. I think the guest talk happened around 1.5 to 2 weeks back. Even Kenneth sir quoted this number. Yeah, 45 to 55% strike rate for an investor is great, but this method is portraying 75% strike rate. It's impressive, right? So I think you understand the pros side of quality investing. Okay, quality business are quality investments. Then why take a risk, right? But let's take a dig deeper. Now from here, we start inverting the question, okay? And what is the question? The question is, okay, we have understood quality companies are quality investments. We have no doubt over that. The data proves that. But we want to just change the question, right? Are quality investments only quality companies? By quality companies, I mean high ROCE, high sales growth. So now we'll focus on this question. Let's invert things. So for that, again, we are people who never want to work on our emotions कि हमें ऐसा लगता है type, because we are neither Buffett, we are neither Rakesh said, we are no one to, so that people should come and believe our point of view. So we'll go with data here, okay? So this time we filtered companies, right, with a simple criteria, nothing else. Stock CAGR of greater than 20%. देखते हैं यार इंडिया में कितनी कंपनीज ने 10 साल के अंदर 20% का कंपाउंडिंग दिया है स्टॉक प्राइस के अंदर. And we just inserted this one criteria. Obviously, the companies were much higher. There were approximately 620 companies. How many? 620 companies which have provided a CAGR of 20% and above. 620. And remember how many quality companies provided CAGR of 20% and above? 73. So out of total 620 companies providing great return, only 13% of them were the quality basket companies. That means 87% of the companies which turned out to be great investments were actually not into quality basket. Hence proved that quality investments are not just the quality basket. We should keep this point in mind, a very important statistics, okay? A very important stat actually. So, but still we need to come onto this portion that, still why you find a lot of people getting tilted on this side of, let's buy only quality companies, right? That's because of one very simple phenomena, that I have mentioned here. It's like, when you are young, you are fresh into markets, right? There are a lot of manner in which, money can be managed and invested. It's just that if you are playing the kind of cyclical kind of investing, right, where the growth rates in revenue and operating profits are sharp uptick, sharp up down, more than understanding quality of business, right? A business का product कितना अच्छा है, इसका management कितना अच्छा है, यहाँ पे competition क्या बोल रहा है. More than that, you need bigger grip over, few things like position sizing, portfolio का कितना % यहाँ पे allocate करना है, risk management, exit कहाँ पे करना है, technical indicator पे या business का कोई OPM ऑपरेटिंग मार्जिन के नंबर पे या कैपेसिटी यूटिलाइजेशन के नंबर पे या ओवरऑल इंडस्ट्री का सप्लाई डिमांड डेटा को ट्रैक करके ओवर कैपेसिटी अंडर कैपेसिटी का. This becomes much more important than understanding fundamentals of a company, the way the people who buy something for 5-7 years wala thing do. And my point is, this is a very difficult thing. This needs to be practiced under a mentor, under a CIO who actually has made money using such approaches, because the drawdowns are sharp. A 200 rupees ka thing fall to 100 rupees like within a snap, within 7 to 10 trading days. And a lot of people end up, averaging down, ke apna buy price kam kar lete hain, and they go into that loop of even bigger loss of capital. So if you are working under a good CIO who has practiced this format of investing, you might actually end up making more CAGR than that quality people, that proponent only by quality wala. And that's perfectly okay. In fact, you should hunt for such managers who have practiced such art of investing. But if you are alone, you have limited time apart from job, etc., to give to investing. The quality approach, tracking a basket of 120, 123 companies to figure out where to put money, might turn out to be also a decent approach. But the point is, even those things have gone for a very long period of consolidations, where although the business has been quality, but the starting valuations were so bad कि आपने कुछ return ही नहीं कमाया. I've just put few charts here. There are a lot of such examples. But we can keep on talking about examples. So look at HUL here. So on Screener, because 2005 se data available hai, but HUL I think went into consolidation from 2003. So from 2003 approximately, if you see till 2011 and 12, it was practically a period of 5-6% CAGR in HUL for like almost 9 to 10 years. it was a great quality company, yeah, across the years, high ROEs, high dividend payouts, but still, even if you look at Infosys, Infosys went into a long consolidation of a range between 200 to 650 700 का range for 16 years. 16 साल में खाली 3-4 गुना पैसा होना मतलब इट्स लाइक ऑलमोस्ट पानी के बराबर है. इन्फ्लेशन बीट हुआ होगा एट मैक्स. Similarly, if you look at one of, again, a great quality company called Castrol India, especially look at the last 6 to 7 years, the returns are actually negative. And whereas if you look at a broad period of 11-20 years, it has consolidated in a very narrow range of 100 rupees to 300. मतलब 200 रुपए का range, just 150% range for 12 years is a very narrow range. And this business, I think Castrol has 50 to 70% ROE, ROCE is great company, but actually negligible return, right? Whereas if I put aside completely opposite examples, I think I have heard a lot of people, sugar बहुत खराब business है, PSUs बहुत खराब business है. Look at this chart of Balrampur Chini. Smart investors have made 3x once a year, 4x once a year, and again 4x once a year. This is what I was communicating. The upturn and drawdowns both are sharp. So if you're able to enter and exit, in a reasonable point, time frame, you also make great money into such kind of businesses. Similarly, there's a great, a newsletter. I think in June 21, it was published by E.A. Sundaram sir of O3 Capital, where he presented a fascinating statistics around PSU returns versus BSE 200 return. In the last decade, you must have heard a lot that in a company to PSU hai, isko reject kar do. But actually, it was never such a case. It depends on the time frame you are looking at. So around 1999 to 2021, for this particular one period of 10 years, 11 years broadly, the CAGR of PSU index is approximately 10.5%, whereas BSE 200 index has provided a CAGR of 15%. But if I take this period from 20 years to 10 years, that is 1999 to 2011, PSU index was actually a much better investment with a 22% CAGR than BSE 200 with approximately 18% CAGR. But it's the last decade, that is from 2021 to 2020, that PSU has gone into negative 8% CAGR, whereas BSE is positive 5% CAGR, 200 index. But even this number is an optical illusion. I will tell you personally why. Because I think majority of the weight here in the PSU index is given to PSU banks, and those have performed very poorly. So for people, imagine you are from that generation who has seen this time period of 1999 to 2011, where you actually became more rich by investing in PSUs. Will you term PSUs as bad? Obviously not, right? But if we are from this era of 2011 to 2020, will you term PSU as bad? Definitely yes. So in the world of finance and investing, the young people who are entering capital markets, or we want to enter capital markets, please make sure about one thing: anything can be justified based on time frame and starting points. So have a broader aspect. Yeah, forget about such good examples. Even in a sectoral rally, buying junk can make profit. So I've tried to just explain, a very important angle here, right? So what happens, when a sector starts to rally? In fact, with real examples, we also have one more blog on this. We'll talk about this examples, I think, in session number 19th or 20th. But here I have just kept some summary of the same. That what happens is when a sector starts rallying, infra rally हो रहा है, for example, या sugar rally हो रहा है, या real estate rally हो रहा है, what happens in generally rallies are broken down into various parts, right? So first part is always the quality companies. The leaders of that sectors, they start making 52-week high all-time highs, right? And obviously those are generally supported by turnaround through quarterly results from a bad period to a good period. Then comes a period of consolidation, where the entire sector does nothing for a quarter or two. Then comes one more leg, where again the quality companies rally. right? Again, those companies rally, they go for further all-time high, further 52-week highs. Now, what happens is after this third leg of rally, right? Third period in the entire sector rally time frame, the valuation gap between the leaders of the sector and junk companies becomes so wide that people think that यार रिजल्ट्स तो इसके में इंप्रूव हो रहे हैं, करेक्ट, सेक्टर का टेलविंड तो इस कंपनी को भी मिल रहा है, बट ये अभी भी 6 के पीई पे है और ये अभी 50 के पीई पे है. A lot of capital rotation happens into the junk side. Those business where long-term returns are very poor, management में कुछ issues है, but business अभी अच्छा perform कर रहा है, and that takes them to a astronomical level because junk है, smaller companies है, liquidity issue रहता है, buying power आता है, stocks rally, they go up 2, 3, 4x very quickly. Even money can be made through this method, and some investors that I know are actually they apply these things very smartly with control position sizing and risk management. That's okay to do. My point is everything can work. Be comfortable with your approach, and that's perfectly all right. So coming on to the conclusion of, our quality business is only quality investment, my suggestion is don't think about quality basket like those 123 companies from an investing candidate perspective, directly straightforward, rather than treat this thing as a source of idea generation कि मेरे पास एक 123 कंपनीज का बास्केट है, ये 123 कंपनीज ने हिस्टोरिकली बहुत अच्छा परफॉर्म किया है, एंड स्टार्ट रीडिंग अ बिट अबाउट देम, एक दो कॉन कॉल, एक दो एनुअल रिपोर्ट, राइट? यू विल स्लोली अंडरस्टैंड के व्हाट आर द मेन ट्रिगर पॉइंट्स कि ये तो एफएमसीजी का बिजनेस है, इसका प्रोडक्ट पोर्टफोलियो वाइड होगा या इसका डिस्ट्रीब्यूशन नेटवर्क अच्छे से ग्रो करेगा, इसमें प्राइसिंग पावर है, तो ये बिजनेस अच्छा चलता रहेगा. Find out few important triggers of every kind of businesses so that you can track the performance of those company clearly. But more than that, wait for some trigger. Not every company can be bought without investment trigger, because I will tell you one very important thing. If there is no trigger point in a business, right, कि historically जो हुआ है अगर डिट्टो वही होने वाला है, बस I think majority of the time that would be priced in at the current valuation. So you won't make any return from the re-rating aspect. You will only make return due to earnings growth. And I'm not saying that re-rating returns should be made. I'm just trying to say that if returns can only be made through earnings growth, right? And please go and watch our valuation session number, I think 5th, where I've explained this concept of PE re-rating versus earnings growth leading to total stock return. But my point is, if the returns can only be made through earnings growth, I think a lot of people, because would be following this quality companies because it's सबके radar पे होती है, everyone would have forecasted that in their DCF model and calculated the present value, and they would be already giving it a very high multiple, and it would be already priced in. Even if you will do a reverse DCF on such companies, you will come to the conclusion that approximately 7 to 10, 12 years का growth rate आज के price में already priced in है. So I think that becomes a bit dicey in terms of generating good CAGR on portfolio, even though you won't end up losing capital. But the point is, you won't end up even making great capital, a great return on capital on your portfolio. So just wait for few triggers, right? कि एक quality company है, but consolidation से गुजर रहा था, रेवेन्यू ग्रोथ नहीं आ रहा था, या मार्जिन डाउन चला गया था. अब सडनली लास्ट 1-2 क्वार्टर आप उसके देख रहे हो, तो वहां पे आपको रेवेन्यू ग्रोथ वापस आते हुए दिख रहा है और मार्जिन वापस से बढ़ते हुए दिख रहा है. या एक कंपनी का एक स्टैंडर्ड ऑर्डर बुक था, $1 बिलियन का कंसिस्टेंट ऑर्डर बुक 5-6-7 क्वार्टर का था. Now order book has started going up to 1.2, 1.5 billion. Wait for some trigger to come. A company which has not done broadly any capex for last 5-7 years, suddenly going up with a capex which is 10% of balance sheet, right? A company which has 60 to 70% of cash as a percentage of total assets because they could not find growth opportunities, now going and planning allocation of that for mergers, acquisition, or product launches. Suddenly some government reform is coming which is providing a huge tailwind to this entire industry, any industry out of, the companies that belong in that 123 quality basket. My point is, wait for some trigger, because as it is, you won't end up buying all 123. You'll have to buy 15, 20. That is reasonable from every angle in terms of diversification. So wait for that trigger, and you can use it as a tool of idea generation rather than going into a debate of a quality business, are only quality investment, or valuations matters, etc. All right. I have, mentioned on few triggers here. Those people generally track what I have learned from my own experience, that you can look forward to. All right, guys, that was session number 2. There are some reading materials that I mentioned, especially for this topic. If you want to develop more grip over this topic, please go and read these links. This have been put on our blog, our forum here at financialclasses.com. Especially, I would like everyone to, direct towards this 7th article. It is, I think, published by Anil Tulsiram, on what causes actually wealth destruction over long term. A great blog that is being published by Anil Tulsiramji. Go and read that too, definitely. All right, guys. Thank you so much for watching our session 2. As again, please subscribe to our YouTube channel so that you get regular updates. If you want to read the entire discussion that we just had, please visit our website. Go under the forum tab right here. I think you should see that. Just one second, I will take the tab up. So when you log into our website, guys, you will see something called as forum here. You can click under the forum, then you will have a lot of categories under which we post good content. You can go to business analysis section here. Correct. You will find, this articles published by us there. And you can also follow us on Twitter. We go by the name Finacle Academy. We post, shorter summary versions of this video and the key excerpts there on Twitter. So you can follow our threads on Twitter. And if you want some funny, quirky content, right? And we don't just, dance or sing on Instagram. We actually post quality content, but in a fun manner. You can follow us on Instagram, guys. We go by the handle name Finacle_Shah. Correct. I will show you our YouTube channel too, if you want. Right. Sorry, our Twitter handle too. You can definitely go there. 1 second. Yeah. Yes, so this is our Twitter handle, guys. Finacle Shah. I hope you can see that. Finacle Academy. You can go and follow that. And you can also follow us on Instagram. All right, guys. Please do subscribe to YouTube channel. Thank you so much. See you back in session number 3.